Tarun, welcome to Validated.
Hey, excited to be here.
Yeah, thanks for coming on today. So you are the CEO of Gauntlet and a general partner at Robot Ventures. And this is part of, I would say, a very unofficial series we've been doing on this show over the last few weeks to sort of step back from the in the moment of what's going on in crypto at this specific moment with specific projects, and to sort of talk more generally about how we got here as an industry, to help folks better understand the difference between crypto and the TradFi system that came beforehand, and how all these things interplay off of one another, and where the evolution of finance has gone over the last, let's call it 100 years, and where it may be going over the next several decades. So I'm really excited to dive into this with you today. When did you first get involved in this industry, and what pulled you in initially?
Yeah, so my story is, I spent the last 10 to 15 years working in simulation-based research. So I was actually working on building custom hardware from late 2010 or 2011 to 2016 at a place called D. Shaw Research. We were building ASICs to do protein folding. So, I think in 2024, people are probably like, hey, why didn't you just use more GPUs? And, the answer to that, I will tell you, is the head of AlphaFold at DeepMind was my first boss. So I think they learned a lot of lessons from us building ASICs that, percolated into kind of some of the more commodity compute stuff. But when I was working on ASICs in 2012, I believe there was basically, we had a chip order out to a supplier in Taiwan where, when you're a smaller chip manufacturer, you write all your hardware spec as software, so that codifies, your design. And you have to give it to someone in Taiwan or Thailand who aggregates orders from multiple different people, and then they combine it and then send it to someone like Taiwan Semiconductor or Samsung or Micron. The reason for that is that the fabrication cycle, you can only get the economies of scale at sort of the level where you're building 100, at that time it was on the order of like $500 million to $1 billion of chips. I'm sure now it's a lot higher. So I haven't been in that industry since 2016, so I'm sure it's changed. But basically, you need to be making huge batches in order for it to be economical. And so if you're a small chip manufacturer, in our case, we're making like $85 to $100 million worth of chips. You have to like team up with other people making small amounts of chips to like get one big order. So that's the context, which seems completely divorced from crypto, but it's actually very related because we made this big order, and this supplier, this person who's supposed to like aggregate the orders, just ghosted us for 6 months. And then said, hey, I'll give you a 10% discount. Obviously, when you pay someone somewhere in the order of $25 to $50 million and they ghost you for 6 months, you are pissed.
Yeah.
And they were just like, oh, we can't tell you why, blah, blah, blah. And then eventually we kind of got them to tell us that it was like a Bitcoin miner who basically paid them to take our block space, literally chip space, ahead of us. And so that was my first introduction to crypto, was that people were building hardware for this. And I was like, this is crazy. So I was like, I'm going to go mine some on my own. So I mined a bunch, of course, like any genius of that era. I sold everything in the bottom. I think I sold a lot of Bitcoin at sub $10. So, that's just the way the cookie crumbles.
Yep.
But I'd continue to pay attention. I think the main thing for me was that I couldn't square the fact that, cryptocurrencies at that time sort of seemed to be in violation of a lot of basic principles of distributed systems. There's sort of a bunch of sort of theoretical results on how distributed systems should work and not work. And, Bitcoin was flying in the face of that. I think in 2015, when some of the first academic research that sort of formalized, why it's able to get around some of these kind of known limitations, that was sort of when I became a believer. I know it's very late, especially for someone who is mining, but I was much more cynical when I was mining. I was just like, oh, like people are building hardware, there must be money in it.
Yeah.
It was not a.
Yeah.
Whereas like I became much more of a pure believer from some of these early research papers, which for better or worse, the irony about them is that they're written by people who now work at Cardano, but that's how the cookie crumbles, I guess.
Yeah, I think it's also fair to say that like there's been a little bit of a rewriting of history of how much conviction there was in the early days. Like I was not around much back then, but I was tangentially around. There were a lot of people that were not in it for a long-term libertarian vision of open and free money. They were in it because you could make money running stuff on your computer at home, and then you could, there was a perception that it was not traceable, which we all know now is actually the opposite of true. Bitcoin is probably the most traceable financial asset to ever been created.
For sure, yeah, but I'm just trying to make sure no one gets some impression that I'm some saint of that era, because until the academic research was good, I was like not a saint,
I get that.
a believer. Let's put it that way. Like I it was very cynical, and I think that's one thing I always see about my friends who work in AI or work in hardware or work in or in academia. Whenever they first come to crypto, they always have the same cycle. They always start in this like pure cynical money side. It takes them a while to realize there's like kind of the depth and breadth, and maybe that's a fault of crypto at large. Maybe it's a fault of the fact that like you can financializing everything does have a cost. But
yes,
yeah. So basically, I was working. Those papers came out 2014, 2015. I was working in high frequency trading by 2016. And I mainly worked on designing sort of like the simulation and backtesting framework. So, when you have a new asset, how do you stress test it? How do you figure out like how you take existing strategies and run it against a new product? So like, let's say, the CME, the Chicago Mercantile Exchange, added like a new product for let's pretend there was like a semiconductor future, right? Like which corresponded to like deliveries of semiconductors or something, right? Like, okay, we take that new product, but now we only have historical data on, say, corn, S&P options and futures, cocoa. I'm trying to remember what the other ones that are having crazy price spikes right now. Eggs. And so those are very different products, right? Like inherently, like the demand for those is quite different than chips. But the thing is, there will be some sort of microstructure stuff that's the same, which is like, hey, these futures close every month. So right around the first of every month, even though they're very different products, different demand, different supply, because people had to like trade the derivatives for the underlying or to keep them in synchrony, that for that arbitrage to close, there's sort of some inherent stuff that's common to all of those. And this is kind of one of those things that I think like until you're in trading or in finance, you don't really think about, right? Like you might look at a stock or a token or something like that, and you think of it abstractly as like, this is the thing that it's supposed to be. It's the discounted future cash flows of X. It's the meme Y, whatever. But there's oftentimes these like little commonalities between assets that should be unrelated due to these kind of structural things of like how you design the market, how you change, how you kind of, the parameters of the asset, like, what one unit is really equal to, stuff like that. And, the goal of most high frequency trading firms is like to try to find those types of commonalities and use that to help you market make. Again, this is like broad strokes. Obviously, if you're working in it, there's like a million more details, but just to give the height. So I'm giving you this context because around that time was like sort of the beginning of a lot of the proof of stake papers and research coming out in 2016. Like 2016, that was sort of like when Algorand came out, the Algorand paper, which I sort of, despite the failure in a lot of ways of Algorand, the blockchain, the Algorand, the paper and the research was actually extremely important at that time. But one thing I found from reading that and reading a lot of the proof of stake papers of that era, this is pre-Tezos ICO, so probably like early 2017, was that everyone was really, really focused on these cryptographic things, and they were very rigorous and detailed about the cryptographic guarantees. Like, hey, if we have this particular type of zero-knowledge proof, we get this type of guarantee. Or, hey, if we do proof of stake in this way, we get this type of guarantee. But no one cared about the financial aspect. And I always found, and at that time, I found it very weird that people were treating these staking assets as financially equivalent to the proof of work assets, because they're sort of very different in the sense that the staking assets could be borrowed instantaneously. Whereas the proof of work assets, yes, I could go to NiceHash or one of these GPU rental places and borrow hash power, but it's not this like instant type of thing. And so that changes the candor of the financial asset. Like the payoff properties have to be different. Then I started making simulations of proof of stake assets or proof of work assets to try to like show that there was this difference, at least numerically, before any formal math. Mainly because I just was thinking of this from the perspective of trading, and I was thinking of this from the perspective of like, how would people trading this asset who are trading the way that like quant traders trade, which is like they don't really give a shit about the actual asset properties, right? They just care about these like microstructure and kind of like statistical properties that don't have anything to do with like what the actual asset, right? And then that's why they can get blown out in years where you have like meme stock stuff, whatever, right? But the key thing was like, I was like, why are these two things different? Can we find some simple explanatory stuff? And long story short, that led me to, I made a lot of this kind of software to test this stuff. I showed it to a bunch of the people who created L1s and did ICOs of that era. Some of them tried to hire me, and I was like, I don't know if I could work for. I hate saying it, but like everyone doing ICOs, no matter how upright they were in a lot of ways, it's just like there's always some scammy nature to it. So like it was just like kind of hard to ever imagine.
Yep.
And so then I sort of was like, but I'll do consulting, and then that, long story short, that kind of led to me starting my company. And a lot of it really boils down to like, how do you think about the statistical properties of these assets? And one reason I keep bringing that up is, the normal finance world in the 80s and 70s sort of had the same kind of revelation of like how you should think about building new assets and what types of financial instruments should be built. But crypto has a lot of different constraints. And so you got to make these totally new sets of assets that have very different properties that you don't have normally. And so that's sort of what really drew me in. And a lot of it came from like trying to understand some of the kind of properties of these things that were seemingly quite different than traditional finance.
Yeah, I think this is a great lead in to a lot of what I want to talk about today, because there's, as you mentioned, the space of trading has evolved incredibly over, just even from World War II, the advent of computers, the advent of powerful math on demand has changed a lot of how markets work, even though I think a lot of us who have not worked in high frequency trading, do not have, masters and PhDs in math, don't necessarily appreciate how different a lot of these fundamental structures are today, let alone the financial products are from what sort of, our grandparents or our parents grew up with using and trading. And so I want to get into a little bit of, on the non-crypto side, the advent of computers changed everything, in part because math was now effectively free and universally available. But walk me through a little bit, I know this is like a very broad question, but walk me through a little bit of what we've seen take place in the traditional markets over, let's call it, since like the 40s, and how that, how there's learnings from that help you think about what the opportunities are in blockchain today.
Yeah, so my very stylized and admittedly, I don't think you can give a perfect history when you were
Sure.
still a zygote or an egg of something. But like the 70s and 80s had a lot of, I would say like the 1960s and 1970s had a lot of probably the first time that sort of on the more theoretical lens, economists were able to say things like, hey, these particular financial products would be very useful in the economy if you could have a way of enforcing contract constraints.
Yeah.
So like if I could have the option to buy stock, if I could buy the right to the option, there's some value to that, some premium that, would kind of maximize utility for all participants. The people who have to be long the stock, who want the right to sell, and then the people who on the other side want some of the supply that's being created. And I think the idea of options always existed for a long time, right? Like futures have existed since the Mesopotamians, in the sense that people would have these kind of IOUs they would buy for commodities. But I think the 60s and 70s was the first time people tried to formalize the question of like, how much should these premia be? Like, how much should I pay for the right to buy Austin's coal batch that he happened to go single origin mine, wherever he was mining? It's organic, exactly. And I think the systematic study of like what premia should be was sort of really done in the 60s and 70s. And a lot of it actually came from analyzing auctions first. A lot of these auctions were like land auctions or rights use auctions because they were done by government. So the data was public and people started being like, okay, this is the empirical data of what people are actually doing. Based on that, let's try to make some simple math of like, hey, could I make a security or an instrument that replicated or was able to give you an idea of like what the premia that existed were worth for these kind of claims on future assets of some in some way.
Yeah. This is one of those things I always find fascinating, that the invention of options and futures predates by hundreds of years our ability to actually properly price these things.
Yeah, I mean, arguably, like I said, I mean, it's realistically millennia because, yeah, there's evidence Mesopotamians trading with other early civilizations like Harappans and whatever had some form of IOU. Like, there is this, you can argue semantically, like it's not a future because we don't know when it's getting delivered and but that all comes later because you care about those things when you want to price it. You don't care about it from a sort of epistemological lens of like, hey, it is really this notion of like an IOU, and I expect you to be able to produce X.
Yeah.
And, but you have to remember that like prior, one of the reasons that this pricing power, the value of the ability to price was not sort of things civilizations valued, was that it was very hard to enforce rules.
Yeah.
So, it's not like you could have enforced, hey, you didn't deliver this, I'm going to kind of go after you in a legal system. At that era, especially when it was like between civilizations, it's actually very similar, as a slight tangent, to like how shipping law is in the world right now, where like shipping laws and like, trade between countries is sort of like, it's very hard to enforce. Like, yeah, who's the enforcer? The UN? The UN never enforces this type of stuff. But the point is that governments over time, over this millennia, got a lot stricter and stronger on property rights. And once you had real property rights, it was a lot easier to be like, okay, Austin, I'm willing to like, I've seen that you've made coal for like a year, and I'm willing to buy your next coal thing. And like, if you don't deliver it, I have some sort of contractual way of going after you.
Yeah.
Right. And I think the solidification of property rights post World War II was actually a very interesting era for why people started pricing this stuff. Like, you had this huge population growth, the resources need to be allocated more efficiently, for sure. But a lot of it also has to do with this idea that like property rights and enforcement of property rights became something that people collectively believed in.
Right.
And there was consensus on in certain countries that like, hey, there were these rights, you could execute them. You can have some form of verifiability of like whether this thing would work or not. So that's sort of my, gesso story kind of retelling of how we got to the 60s and 70s being the first time. Now, obviously that's a lot of opinion, a lot of, but
sure,
I give you the disclaimer. But once people started really analyzing stuff, they started being like, hey, actually, and they started to have computers, so they're able to do like basic sort of math on these things and analysis of this data that was getting collected. People started to say, hey, actually, if you have this ability to enforce these rights, then like now I can actually price this thing. Like now there's some value to buying the right to Austin's future coal production, right? It's not just like a trust me, bro, I hope he doesn't send me fake coal or, one of those types of things, right? Like there is some real guarantees.
Yeah.
There are some real guarantees. And at this time, things like options and futures became valuable. And I think the key thing is that you needed this ability to enforce rights, but then you also needed this like little gestation period of people observing that when people had those guarantees, there was some predictability to certain types of assets, right? There's some predictability to the returns on a particular asset. So people who want to get liquidity are willing to sell their rights to those, and people who want to kind of own more of those assets became able to do so.
Yeah.
And the 1980s, especially, the early post-DARPANET internet era, that's sort of when you had the first sort of trading of these assets electronically. I think finance generally is always the earliest consumer of new technologies, but generally is bad at consuming them once they've grown. Inevitably, because sort of the advantage for financial kind of entities is usually like, hey, we're first to something, everyone cares about it, and once they care about it, we're out, right? Which is quite different than sort of like a more technology view of things, or like most other types of industries, how they view things. But finance was one of the first consumers of the internet and data in the 1980s. This led to people, I would say, like sort of the UChicago Columbia school of people who trying to basically, convincing these kind of exchanges like, hey, you should offer these kinds of futures products and options products and stuff like that. And, I think it's no coincidence that Chicago is still relevant in finance, that like UChicago is also there. Like there was like a very clear gestation between the two. And basically, people started making theories about these products. They started writing math about these products, saying like, hey, like if the prices behave in this way, then, hey, we can give you some guarantees on how these derivative assets should be priced. So like a lot of the math of that era was like, hey, we've observed these things historically. This is how the derivative premiums trade relative to the underlying things. And then based on that, we can try to say like, hey, if that pattern holds, or there's some sort of, it's stationary, then like we can give you some pricing models for that.
Right.
And those pricing models in some sense led to oftentimes, there's things where you make models about things epistemologically after they happen. So like that's like more like science, right? It's like I observe, some physical phenomena. I look at the data, I try to back out like what some form of a causal description of it, and then I try to say, hey, that's what this force is doing. There's the other type, which generally happens more in the sort of social sciences and other sort of areas that try to use quantitative analysis, but it's a lot more noisy, where the idea that there exists a model makes people suddenly do the action more. So the idea that there was a model for pricing these things made people actually want to trade them more. And so this was sort of, I would say, like the options pricing, the bond pricing, stuff of that ilk in the 1980s sort of really took off because of, to some extent, the fact that there was a model to price these things that were previously, they existed for thousands of years, but they were invisible to the end user, right?
Yeah, this has always been interesting to me for a few different reasons. One is like, there's like a meme that finance never wants to take any risks. And it's almost like a joke at this point where, a lot of the TradFi work is intentionally quantitative because it feels like it's a risk reduction system. And there's a version of that which seems silly. There's a version of that is like incredibly logical and consistent. And of course, that's what you want to do, is to de-risk your positions as much as possible. The place I always go with this is like, it's the stuff that you never predict in your risk models that goes wrong, that always causes financial catastrophes for the most part. But it's interesting to sort of think about the interplay between like having the ability to price options and futures, having the ability to hedge your positions now with these tools in a way that feels like it's backed up by math as opposed to being backed up by more soft judgment.
Yeah, for sure. So I think there's a couple things to unpack there. So I think established financial products always have this like everyone is conservative because they like believe their model, and then
Yeah.
They trust that a lot. I think there is a sense in which people basically, when they construct these models, I think with enough experience of things blowing up, you eventually become very accustomed to the idea that no model is going to be perfect. And all models are sort of wrong in some distinct manner, right? They're measuring a point in time, a set of points in time, and a set of points in space that are not necessarily going to recur exactly again.
Right. So that all models are wrong, some are useful.
Yeah, it's just more about like what intuition can you get from a particular model, and like how can you change the model to reflect intuition that would help you currently, right? Like, so having sequences of models, having models that are dynamically adjusting is sort of a way of you benchmarking your soft guesses against against something that's more tangible. And I think an interesting thing about finance is usually there are people who are high on the risk spectrum, taking a lot of these risks, generating this data. And then there's people who are low on the risk spectrum, analyzing it, low in terms of low, meaning they're highly risk averse,
right?
Analyzing it, finding a model, and then people who are in the middle, sort of the midwit of the midwit meme, take those models and suddenly are like, oh, I'm ready to trade on this. And those people are most of the volume that gets generated, right? So that kind of thing where there's like kind of the what's the word for like wildcatters, like the people who would like go out in the country and like find crazy, try to search for oil or whatever, or gold or some commodity. There's always a wildcatters of finance, and I think the problem is the brands in finance are generally the ones who are the risk averse or the midwits, but the wildcatters always exist, and they're the ones finding new products that come from effectively tranching some form of new risk or taking advantage of some form of new types of property rights that exist.
Yeah.
And in general, those people probably don't get as much historical lauding, but they kind of created everything. But also they are generally rewarded quite favorably by the market, that it benefits them not to be like, public as much. So there's kind of this natural thing that like everyone comes to that conclusion that, oh, finance is boring. Everyone's, but it's not. It's sort of a weird thing. In the same way that I would probably call, like, even though you might not think of them this way, like Zuck or Sergey Brin, like wildcatters, because they found a new financial instrument. No matter how much they want to spin it to you as changing the world, bullshit, which is like not really true. They found a new financial instrument. They found a way to sell things that look like futures on bundles of advertisements, right? So like something where before, like a media outlet or a newspaper had to sell a single ad for a single item in a classified ad or a page ad. They found a way to sell you futures on bundles of those items to particular users, where like the item only existed when the user shows up. So if like they're trying to sell to like 30s Indian male with colored hair, like hair coloring products or something, if that person never shows up, then the item doesn't exist and the option value is zero, right?
Yeah.
Like, but the idea that person could show up and I can prove to you that I gave it to that person, that I can allows you to create this new type of claim on future rights, right? And you could fundamentally view anyone who makes money off ads as like they basically created this not a security, which is like a total lie. Like in reality, almost all online ad revenue should be viewed as security if you're going to call crypto securities.
This has been my argument
like you
for
can't
years. Yes, that like if
you
the
can't
internet
like split the two. Right?
Yeah, if the internet were invented today, the SEC would say the entire thing is a security because there's nothing you can do in the internet that doesn't involve some form of transacting, some form of value transfer, and as you're saying, some form of effectively a futures contract.
Yeah, it's like sort of a future or an option. Like I think the weird part, and this is part of the reason that perhaps like the Facebooks and Googles of the world were never prosecuted. I mean, you know, it's not an exaggeration to say like the smartest people don't usually end up working in government.
Yeah.
And so somehow like they couldn't see this, but this idea that you have these like conditional assets, like the idea that the asset is conditional on this person existing, I create the asset and then I sell it, but I've sold it before the person even exists. That is sort of a weird thing, right?
You've arguably got a strike price too.
Right. You're creating and destroying assets on demand.
Yes.
Which is something I think people didn't realize was even possible, right? So this is, again, one of these things where like technology and property rights can conspire to suddenly make something that seemed not valuable, right? Because you can enforce things, you can verify whether they happened or not, and you can have high probability bets on them. And yeah, most of modern 2010s era tech in my mind is like effectively the wildcatters who figured out how to sell you new assets that were previously unmonetizable, either due to technological reasons, either due to like verifiability reasons, like I couldn't verify this contract to be executed, so like why would I enter it? And in some ways, to me, the beauty of crypto is that it like does have those properties very transparently to you when you're creating these instruments, and that's sort of why I think it's interesting. It also has a lot of nuance into how you think about asset pricing because, you know, in the normal world where you assume there exists at least one sort of like trusted party who acts honestly at all times, you assume that that person, that agent, doesn't change type. And what I mean by that is like if you Austin are running an auction to sell your coal. Sorry, I don't know why I keep making you
I'm a coal broker.
Whatever.
Couldn't have been solar power or something, and nuclear energy.
Yeah, I just wanted something that was like visceral. You know? Maybe I'll make you an eggs dealer, but because given that eggs are flying, egg prices are going up crazily because of the avian flu stuff. But say you want to you run an auction to sell a bunch of eggs. Well, everyone who's bidding in that auction, who's physically showing up, knows that you can't be in two places at once. Like imagine running a physical auction. Like you're like $1, $1, $2, $2. You know, like the meme of the auctioneer. Well, everyone there knows you can't defy physics and like suddenly become a buyer. But in the on-chain world and in crypto assets, there's nothing stopping me from making a new address and bidding in my own auction and suddenly trying to push the price up. So like I try to, if I'm the auctioneer, if I can find the person who's is the most inelastic to price changes, and I identify them, then I can just keep adding bids to try to push them up so that they makes me more revenue, even though like I know that it's my bids are non-economic. They don't represent like me valuing the item. They represent me trying to push someone else's, change someone else's value for the item. That's a very different thing than normal finance. So normal finance, you sort of have these constraints where you assume particular parties, whether they're a broker, an exchange, whatever, has some trust property such that they can't change type in the sense of like, there's, the formal sort of economics or game theory definition of what a type is. But intuitively, it's this idea that the auctioneer can't suddenly like clone themselves and also bid in the auction. But on chain, they can always do that.
Right.
And that changes the math for all these things. And that's sort of where, like, at least research-wise, like, I'd say 90% of the papers I write boil down to, like, trying to find some phenomena that exists on-chain. And basically trying to understand, like, where the math of that thing differs from the closest centralized object. And this is, again, one of the reasons I think, if you look at DeFi protocols that have succeeded and DeFi protocols that have not succeeded, oftentimes the ones that don't succeed are the ones that try to take something from traditional finance and it's like, hey, we're just going to make X on the blockchain.
Yeah.
Right. I think a really great example of this and a really great example of the difference between traditional financial instruments and crypto financial instruments is looking at, not to come back to the quintessential easiest example of this, but options. On-chain options have historically not worked really well. Now, there's a lot of different ways of analyzing why, but the first thing you need to know is that, one of the things I think in the 60s and 70s that sort of economists and people in operations research and stuff like that figured out was, hey, one of the reasons you want to have these instruments that allow you to price premiums for future delivery. So an option is I choose a strike price. I say, in the future, you deliver to me at this price, is that if I imagine I had an infinite number of options at every strike price and every duration, there's sort of a mathematical thing you can show that says, hey, you can replicate, you can kind of hold a portfolio of these assets such that any payoff you write, I can draw an arbitrary function and say, I want this payoff. When the price is this, I want to get $2. When the price is this, I want to get minus $2. When the price is this, I want to get $7.
Yeah.
Right? I can draw this payoff curve. With an infinite number of options, you can basically replicate any payoff. And so that was sort of the theoretical thing that made people be like, oh, well, yeah, obviously this corn broker, they hold a lot of risk. They want to hedge, and hedge, they need to figure out what the payoff is that cuts that particular thing. And if options with enough options, I can replicate the opposite portfolio, I can kind of be neutral-ish.
Yeah.
Right. And that sort of was the theoretical reason that I think it happened.
Yeah.
So options are sort of this fundamental object because of that, because they sort of, with enough of them, you can get whatever you want out of it. But there's obviously a financing cost, right? For each strike price you have, there's some sort of inventory cost. Market makers have to be able to quote at those strike prices. And there's inevitably some sort of liquidity cost, which says hey, yeah, you can replicate this payoff, but it's going to cost you a lot. There's going to be a lot of transaction costs to even generate it.
Yeah.
And in the normal markets, there's sort of structural reasons that these types of things have sufficient liquidity. One of the first things is governments charge taxes on fixed intervals. And so there's just a very natural reason to construct things that avoid these tax intervals that defer payment so that you can get a lower tax rate of some form, right? And so you kind of have this thing where you have a lot of these duration-based instruments that have a fixed duration in traditional finance that really stem from commodities are delivered at fixed intervals, frozen pork belly futures don't really trade in January, but obviously they trade a ton in June. You have these kind of constraints that are temporal naturally from the real world. You also have these ones that are socially occur, taxes are collected every year on a certain day. But when you rid yourself of those constraints, suddenly you might say, hey, are options a very efficient way to generate these payoffs? Because I need to have liquidity at every single strike price.
Right.
And I have to have enough strike prices such that it's, I can replicate this curve very well. And effectively, what you find is that when you don't have these constraints, you actually find it very hard, and you charge people per action. So hey, if I'm a market maker updating a quote on an option, well, I have to pay a gas fee for every update. It changes my economics quite a bit. And so in a lot of ways, options are just, while they can replicate any payoff, they're inefficient from a liquidity standpoint when you don't have the constraints of traditional finance. Now, the question is, are there other assets that can replicate these payoffs? And I think, kind of a lot of the papers I wrote in 2019, 2020 were like, hey, like this AMM thing, somehow people seem to be using it in a lot of ways to replicate all sorts of weird payoffs that in
Yeah.
normal finance you would be like, I don't really get why you would choose the square root payoff. It's not like an intuitive payoff. And but then you start to realize, oh, actually, in this world where you have to pay per interaction that you make with the thing, you actually want these kind of different payoffs that like guarantee you liquidity over large ranges of prices rather than, very, tick by tick type of things. And so, long story short, or really short story long, I guess I ranted for a while, is these kind of like assets people like on chain tend to just have very different properties because they don't have the same constraints. They instead of the constraint being temporal, like
right,
time-based things, it's actually gas-based things, right? Like, is this thing efficient in a transaction cost manner? And I think that's sort of why you see all sorts of weird assets on chain. And I think like if you look at the history of a lot of these traditional financial assets like options, like futures, like swaps, they all come again from this idea of like pricing or online ads. They all come from this idea of like pricing the invisible. There was something that like was unreachable before, and suddenly some technology makes it easier to have guarantees on it. People start pricing it. The wildcatters are the ones creating that, and then eventually, people backwards find ways of reasoning about how to compare it.
right.
And I think crypto is like the place where you see the most of that. Whereas like traditional tech, I feel like was ironically that 10 years ago, despite, everyone there saying like, oh, we don't do any finance. That's kind of a lie, if we're being honest.
Yeah, most tech from 2000 onward is just a lot. I mean, Spotify at the end of the day is as much a engine for distributing micropayments and royalties as it is a CDN network for music files. And to try and separate the financial innovation from the technology innovation, I guess leaves you with Linux is probably the only piece of like non-financial technology that's gotten a lot of adoption in the last 20 years. But it is interesting to sort of think about just how under the hood most of these companies are just financial technology companies.
Yeah, it's sort of like they do a lot of stuff that has some tangible utility outside of the actual financial instrument. But if you squint enough and you look at what they're selling, generally it's like some weird financial product.
Yeah,
like and that's sort of why I find the government kind of, we're putting a line in the sand of what's a financial product and not, kind of like doesn't make sense to me. Because it's just like you run into all these contradictions where like, right. But whatever. This is not a podcast to talk about government stuff.
No, but like I think to your point, like there's all these funny stats about how the only profitable division of General Motors for years up to the 2008 crisis was the lending department. Everything else lost money, and the cars were basically just a way to generate loan issuance. And that you can track this back. I think it was Southwest Airlines that made 98% of their revenue on trading jet fuel futures because they're a big purchaser of jet fuel, and they made almost no money on the actual air carrier operations for years. But I think one of the places I really want to go with this is two questions. The first is, given this market opportunity, given that you can do things in crypto on blockchain you can't really do in other markets, why has it been so long for traditional financial players, even private hedge funds and HFT firms, to enter this space? And the second one, which is sort of an extension of that, and we talked about this a little bit already, but what do you see as the type of financial transactions, financial products that are really only possible or only economically viable on blockchain? Like, where is there actually green space that blockchain is creating that traditional finance has not been able to create?
Yeah, great question. I mean, I think as boring as the answer to the former sounds, it's really probably boils down to really three things. First, the infrastructure is annoying. Like, finance people have just like not been used to trading 24/7, except in like FX and a couple like people who do international equities, like ADRs and stuff. But it's like an industry whose entire infrastructure is built around like 9 to 5 in some way, and in some indirect or direct. Like there's like some notion of temporal beginning and end.
Yeah.
Right. It's like, why do we have the opening auction have like all the volume, or the closing auction have all the volume? Like, in fact, one funny thing about traditional finance is like, as HFT grew and people started trading much more algorithmically, you had this thing where like prior to say like Reg NMS, which is the SEC, the Neutral Market Service, which is basically this law from 2005 that basically says, hey, when I ask for a price on an exchange, a market maker has to look at all the exchanges and find me the best price. So like the kind of highest bid if I'm selling and the lowest offer if I'm buying. It's called NBBO, National Best Bid and Offer. And what happened after that, if you just like look empirically, is like people's trading throughout the day was kind of random, but it was like, you could think of it as like a flat line as a function of time, like from 9 a.m. to 4 p.m. And then once it became much more algorithmic, you saw almost all the volume concentrate to like the beginning of the day or the end of the day, and like the middle of the day has none. It's like this U-shaped distribution of volume. And so part of that was because everyone was starting to just be an algorithm, and like even people, retail users, when they made a trade, like it was getting internalized by someone else, and so like those people would just hold the inventory until the end of the day or things like that. And you kind of had this very funny thing where like the fact that it had duration, the fact that it had a beginning and an end, conditional on these kind of like algorithmic changes, just changed the market structure to only trade at the beginning and end. That's very different than crypto, right? Like, yes, people, especially the very boomer, like the most boomer kind of like, sometimes I find most cringe people on Twitter are like this like extreme TradFi people who like are not super quantitative, who are just like trying to always add fake times to things in crypto. They're like, oh, this is the Bitcoin close for the day. I'm like, what the fuck does that mean?
What does that mean?
Like that that varies from day to day. And like, close for who? Like people in Asia, this is their morning. Like it's just like sometimes you read some of this stuff and you're like, I don't like, clearly no one is actually paying attention, right? Or like even just going to like CNBC, it's like they write Bitcoin closing price daily, and it's like that was a made up thing that like some data firm gave you so that you could like pretend that it looks like a normal market in that way. So don't underestimate these. The reason I bring this up is like the temporal constraints of normal finance actually change the behavior of people, and removing that is quite hard. And it changes how you have to think about the market in a lot of ways. So that's the first thing. The second thing is, of course, the boring one of like government. Like, okay, like people feel scared. And I think the third one is, and maybe this is like the one that's like, hey, there's all this sketchy stuff or Ponzi schemes or whatever, is that this ability to create and destroy assets at will is a very different power than you have in normal finance. Normal finance is like, you can't just like create an asset just for a small time and then kill it. But in crypto, you can very easily create tons of assets and, destroy them later. In the same way that like I was describing like Facebook and Google is like, you could imagine they're effectively like a application specific blockchain in some ways, where they like only offer you this one kind of weird payoff, but they're creating and destroying assets, right? Like
inventory.
The asset of you being the person, meeting some characteristics, and there's an ad that is created just in time to sell to you and then destroyed because maybe that ad doesn't work for anyone else. That's almost the same as like creating a coin, doing a trade and then destroying the coin, right? And so there's sort of a sense in which these companies are basically doing a sort of a very specific form of that, of like adding and removing assets,
right?
But in general, if you look at a lot of things in in DeFi, if you look at a lot of things in crypto at large, there's just this like natural thing where you're like, hey, I'm going to like create this token for this particular transaction, then delete it, right? Like, and that form of programmable securitization is like very hard for old school people to understand.
And so what do you see as the types of things that this technology enables that really traditional finance has not been able to build products and services around?
Yeah, so I think it boils down to something like someone like Facebook or Google, they like happen to create this thing that has utility and then backwards induct a asset that that kind of like you can use for it. The question to me is like the forward version of this, which is
Right.
imagine I have the asset and I'm able to then use it to create some not on-chain utility out of it. So like I have an asset on chain that like, and because it has some trading volume, is able to create some like offline or, you know, social type of experience that's totally different because the asset exists. And so like, you know, despite the fact that we're kind of still, people haven't taken crazy risks on this, I still generally think like the DePIN type of stuff is like something of this
Yes.
framing, right? Where it's like create the asset and use it offline. And I generally think there's going to be some form of like new type of social network. Like calling it a social network itself probably too boomer.
Yeah.
There is some type of new thing, whatever it is, like that is, you know, like a TikTok type of thing where vampire attacking the existing ones by having the original asset and being able to create and destroy assets like per user is a superpower for like owning attention. And like you could you know, like I definitely hate investors intellectualizing meme coins, but there is some truth to the fact that they kind of have this behavior, and right, it's like as soon as this earthquake happened, there were like 30 meme coins made about like it's almost like a news feed, like if you in some very funny way, it's like incentivized news feed.
Yeah, it's like what if you could buy trending topics?
I mean, you kind of could, right? Like I could make some smart contract that just like looks at all the new mints on like some particular DEX and buys you some rotating portfolio of them.
I mean, just look at the political tokens, right? Trump and Bowden are great examples of a, you know, one way to look at this is like a silly meme coin synthetic asset that means nothing. And the other is just we have created the purest expression of an attention market that I have ever encountered.
Right. And so that's where I think this stuff is useful. Like this idea, the inflexibility of the Facebooks and Googles to create and destroy assets outside of the scheme of like the asset is created when like a particular set of desiderata are met.
Yeah.
Is something where I feel like there's going to be a new form of like attention collection. That can happen. And it's unclear what that is, but I would argue that unlike the tech stuff where it's like we have this utility that came first and then we backwards find a security for it, and I'm calling it security because if you call crypto securities, then this shit is the same shit. Like there's no way you can argue that. Like I get that we don't have the smartest people in government, so they don't see this, but it is literally the same thing. And I think like the idea that you can make these assets on demand in some ways is like this crazy attention thing. And like, that's where this meme coin current thing is like, makes me think that there's some way of that turning into like a product.
Yeah. I mean, it's sort of like, there's like a moment when I think a lot of people who are like just getting into finance, whether it's through crypto or they're learning about it in college, where they sort of realize that low interest rates literally create buildings. That like there is a direct relationship of if you drop interest rates, there will be more construction, and the construction would not exist if not for the ability to get low interest rates. And like there's a direct relationship there that feels very counterintuitive when the ability for an asset's existence to create a market opportunity for something that feels very disconnected from the financial world, like a new office building. Yeah, people very much underestimate how tightly a lot of these things are directly coupled. And it's interesting to think about, what are the impacts of being able to create assets on demand and destroy assets on demand for other types of things within the fabric of society.
Yeah, exactly. There's clearly something about like, okay, so let's take, I like the 2010s. I'm trying to pick like a year, maybe like 2015.
Yeah.
Like peak VC hype, right? Where like everyone was like, oh, like the best returning thing in history was like should have invested in Facebook. Why did we miss it? Well, everyone who invested in Facebook either invested sort of emotionally, or they kind of were like, hey, we only care about these metrics that are non-financial.
Yeah.
And eventually you can turn those non-financial metrics into financial metrics, right? Well, what is anything that takes this non-financial metric and converts it to a financial metric? That is the point of like a security, especially a derivative security.
Yeah.
Is like it's able to let you kind of like convert. It does a liquidity transformation. It takes this like illiquid thing that like you have a sort of quantitative estimate for, akin to like a premia for an option, and it lets you make it a liquid thing that you can trade.
Yeah.
And this illiquidity to liquidity transformation, what do we call most people who do that? We call them banks. But like it exists in a ton of places. Like it's like Facebook is a fucking bank in that sense. Like they are taking this like a liquid thing and selling it to you.
This is the closest thing we've ever created to actual alchemy.
Right. And I sort of think the problem is like if you look at the investors of that era, they pattern match to that, and they're like, okay, like give me a metric that I can like liquefy, right? And it reminds me a lot of like post DeFi summer of like a lot of people being like, oh, give me a metric that I can like try to trade, right? Which is like, give me a copy pasta fork of some protocol so that I can do the same thing. And obviously, in the same way that a lot of these investors who try to copy trade the Facebook thing lost their shirts, same thing happened to people in crypto who are trying to do that. But there is a sense in which the thing I think that's fundamentally different between like the crypto world and the Web 2 world is that the Web 2 world relied on like creating these sets of metrics that were illiquid in the sense of like, you had to spend money on getting customers who are using your thing and then making them liquid via like selling these ad securities. But here we could do that process in reverse, which you can't do in the normal world because you have no guarantees on these property rights. If we get back to the fundamental thing, like having no guarantees on how to that owning this abstract thing actually corresponds to this real thing, which is the backwards part.
Yeah.
Like no one would value the Facebook ad impression before they had the network, right?
Right.
But in crypto, you can do the reverse.
Yes.
And the question is like, what things have more value from the reverse than the forward?
Interesting.
And
that's a really interesting way to think about it.
And to me, those are the things that are like things that crypto will be better at. It's a very long-winded way of getting to it. But.
Right. Things where the existence of the network accrues the value before the product exists.
Yes.
Yeah. Which is interesting because another way to talk about this is literally just investing. Right? This is what every VC does every day.
It is certainly true, but there are things where...
But a VC could never come to the outcomes, right? Like there's something about the public distribution and the public market model that is incredibly different than a private market model.
Well, also this idea that like the users can create and destroy assets and not the investors.
Right. Yes.
And this is why I think the meme coin thing is getting at something.
Yeah.
Like, despite the fact that like there's a lot of bullshit, there is this idea that like around every event, people are making 1 million of these coins and trying to get attention for it.
Yeah.
Is almost like an incentivized ranking algorithm for a timeline.
Yes.
And like and there's clearly something there. Like I just don't know like how you channel that into something more that gives utility to like the average person who isn't like a degen.
I kind of love that like way to look at this of like we've financially incentivized the TikTok trends, right? Where like you'll see
Right.
a trend take off on TikTok and everyone suddenly is using some audio or doing some action or doing something with their video, but all of that is totally unmonetized except for influence or endorsement. Like all the monetization engines are very indirect, except for the one that Facebook runs or TikTok runs, which is the ad engine that
Right.
sits on top of it. And what if you can communityify that and decentralize that and actually create broad-based value creation on demand based on these sorts of things? Like there's an interesting model there.
Yeah, and you need the users.
Yeah.
Whether to be able to control this asset creation and destruction process.
Yes.
And the meme coins are a dumb way of doing it, but like there's probably more something that like I don't know exactly what it is, but it's like there's clearly like something that is the form of the attention economy where you own the rights to your kind of creation.
Yeah.
And like I know everyone always talks about this kind of like
own the memes.
like
yeah.
Chris Dixon type of like ownership stuff. I find that a little too waxing poetically, philosophically about it without thinking about the fact that Facebook is just a securities dealer. Like if you boil down TikTok and Facebook to being like these like sellers of these like conditional securities, then you suddenly are like, okay, well, this ownership thing is also a little bit tenuous. It's like, well, I what does it actually mean to own it if the value of the thing also goes to zero at the same time? Like, yes, I own it, but it went to zero.
Yes.
So like, do I, like you have to have some utility measure, not just a strict, do I own the private key type measure. That's where I find these kind of ownership only narratives wrong. Like they really are missing this idea that you need to have this ability to have the value function expressed by people control the algorithm that dictates whatever your ownership is. And in some sense, that is why I think people are going to find something that's like a social experience where you need this notion of like the creator creating the asset, not just nice to have, right? Because like the influencer marketing thing is basically creators creating their own asset,
right,
external to the thing, right? They're basically doing the permissionless kind of thing. And so the question is like, how do you make them do that directly?
Yeah, and it does, the conception that ad markets are in some ways just futures and derivatives markets does sort of simplify down the question of why so many of the end state of network products are ad networks. Is because today that is probably the most capital and technology efficient way to create a financial market for something that is not, as you were talking about, this sort of alchemy of we take something that is non-financial or illiquid and we make it liquid is through today something like an advertising model. And I think the thing we're circling around here is neither of us knows exactly what that will look like in Web3, but there is space for it to be something very different in Web3 that can be that can have a much broader impact than just advertising.
Yeah, and I think that's sort of this idea. Like, there's one way of viewing these like on-demand meme coins that are created when an event happens as a form of advertising, right?
Yeah.
Like, but I think that's like the wrong way of doing it, because it's a form of advertising where there's 500 of them, right? Like I said, this earthquake thing this morning. I went and I just searched earthquake in Dex Screener, and there's like 50 coins that were made, and they all have like slightly different variants of it. And it's sort of a sense in which people are competing to give you an ad as opposed to like you just, the other way where you're fed the ad. And to me, that's kind of, again, like there's some form of that being like a timeline or a news feed that's like, imagine just making a product that literally just takes an LLM, takes in the new meme coins created over the last hour, and has the LLM write you a summary of like a news feed, like timeline. Honestly, that's not that crazy.
Yeah.
If that makes sense. Like
No,
there's
that
clearly
completely makes
something
sense.
going on.
Yes.
Like that's like reversing the who owns the algorithm, like the ranking algorithm.
Yeah, it's this thing I always think about like how on earth did BuzzFeed fail? Right? Is a question that I think is one that's been underexplored because everyone looks at it as oh well the media model didn't work, the business model didn't work, but like at the end of the day, um, that idea that everyone on the internet was arguing about whether the dress was blue or gold, right? Like there is something incredibly powerful there.
I like to think of BuzzFeed as the African cacao farmer and Facebook as the commodities trader.
Yeah.
Because like that is kind of the relationship, and like that's why all journalists who are like old school are just like, oh, it's like sucks. The media business is completely dead. Whatever. It's like, yes, but that's because before the media business owned both the trading house and the content creation. They're like vertically integrated,
Right.
and that got disintermediated. And in some ways, if you disintermediate the clearinghouse and the securities and commodities part of it, which is like hopefully what the crypto part is supposed to do, you can like there's a sense in which like everyone who's complaining about how journalism is dead, whatever, wants to rebundle, re-verticalize, right? But I actually think the interesting thing about crypto is it's like trying to continue the unbundling. Like we already unbundled the farmer in Africa from the commodities exchange. Now we're unbundling the commodities exchange so that it exists everywhere, right?
Yes.
And I think that's like that's a philosophical difference, right? There's like the side that wants to like go back and rebundle things, and the side that's like, no, let's like keep unbundling forever.
Yeah. There's a world where like sometimes I'm talking to like some of my more lefty friends and like trying to get them to understand like how crypto isn't just a mass extension of capitalism, and there's an answer there which is like, no, this is something totally different. We're building community-owned infrastructure, etc. And there's the other answer that is we've just like supercharged neoliberal capitalism, but in a way that actually improves it for everyone. That now everything is financialized, everything is a market, everything operates in these ways. And by removing the sort of private and privileged access systems that have dominated traditional finance for years, we're actually going to create a much more fair and equitable world on the other end of it because of that. And it's a very interesting way to kind of view these. I think the unbundling will continue until we've basically atomized everything.
Right. And also made things more easy to make and destroy on demand.
Yes.
I feel like that's the thing people don't get about crypto is that like it does allow people to like make things just in time a lot more than like the existing world.
Yes. Well, Julian, I know you have a heart out, so appreciate your time today. This was a really interesting conversation.
Yeah, hopefully I sort of the genesis of this episode is you tweeted about trying to find someone who has this sort of opinion about traditional financial instruments versus crypto ones. So hopefully I met the goals of your tweet.
Yes, no, love it, and would love to have you back on some point in the future to dive more into this stuff.
Great, thanks a lot.
Thank you.